financial markets in turmoil.
What are the root causes of the financial crisis?
The dollar losing value.
Heading for its biggest loss in nearly 3 decades.
Will Social Security even be there?
I don't know.
Buy or rent?
That's a very good question.
Interest rates.
I'm not so sure.
Where do you put your money?
I don't know.
Welcome to the show that answers your questions. This is Follow the Money Weekly with your host, economist, and best-selling author. Here's Jerry Robinson.
Well, friends, welcome to you all around the world. Welcome to Follow the Money Radio. So grateful to have you along for the ride today. So we do have a very good show lined up for you today. We're going to be talking about 5 simple rules for swing trading. I'm going to be talking to you about the topic of swing trading today. In fact, we just did a really powerful swing trading course. We just put the course together and we delivered it to all of our members this week. It's called the Swing Trading Course, an Introduction to Profitable Short-Term Trading. So if you're interested in short-term trading, moving in and out of stocks, in and out of ETFs, maybe even in and out of cryptocurrencies or commodities, this podcast will be very helpful to you. And the topic of swing trading has become more popular, of course, in 2020 as more people have been tuning into the stock market. Robinhood investors, have been piling in. We have a lot of retail investors and new traders, and we see it here at Follow the Money. Many questions from new members asking about, how things work. And so we thought today on today's podcast, we would directly hit this topic of swing trading, especially since we have the course now available. You can find it in our website. Just go to followthemoney.com/shop. And you can find the swing trading course right there in our online store. Very, very powerful, but also, compact. It's all fits in underneath 80 minutes, and it's an 80-minute video course that will take you through so many things. We talk about the importance of understanding trends. We talk about the difference between swing trading, day trading, position trading, which we'll talk about briefly here in just a moment. We also talk about in this course chart reading skills for swing traders and 4 moving averages that all swing traders should know. We talk about the best indicators for swing traders and stop loss strategies for swing traders. Many powerful swing trading entry and exit strategies, along with some trading pitfalls to avoid, and the ultimate key to swing trading success. So all of that is now in this brand new swing trading course that I'm talking about. And today, what I really want to do is I want to dive in deeply into 5 simple rules for swing traders that will help you on your road to trading success. I've learned quite a bit over the years. I placed my very first swing trade in 1997, nearly 25 years ago. It's hard to believe. And since that time, I have learned many lessons through the school of hard knocks. But one thing that I can tell you is that swing trading, in my opinion, is a fantastic way to generate a new income stream. And it is a strategy that can be used in a retirement account or in a regular brokerage account. And since 2012, I have personally been publishing a daily swing trading idea for our own premium members here at Follow the Money. And we place all of those, by the way, on our website. So all of our closed model trades are available to be seen. And I'm just sitting here looking over a few of our latest closed swing trades, the trades we had issued to our members. And I'm looking at several winners here. We had Sunrun, for example, a solar stock that I particularly like, ticker symbol RUN. We put out a trading idea on it back on the 20th of November for all of our members. We had a trigger price of 61.88. Trigger price is where we would actually say this is where the uptrend begins, or this is where we would want to enter. It would be an entry price, basically. And Sunrun went on to rally 12% in 5 days. Wow. It's 12% in 5 days. That's, that is actually a very nice return for any trader. We also had the U.S. Oil Equipment and Services ETF, ticker symbol IEZ. We put out an idea on it back on the 16th of November, and we had a trigger price or an entry price at $9.18. Well, the ETF rallied as oil went up. We saw the rising price of oil. We saw the 200-day moving average breakout. And IEZ went on to rally 21% in 7 days. We also issued another idea. I'm just looking back at the few last ideas we've had here. We had an idea on digital turbines, ticker symbol APPS. This stock rallied about 8% in 2 days from our trigger price at $35.52. So our members receive every day a stock chart with our entry and exit strategy, our stop loss recommendation, our comments on the trade, why we like the trade, and all of this. So if you're an aspiring swing trader, our services are really, just really perfect for you if you're looking for short-term trading. But we also do a lot of long-term trading. In fact, I'm what you would call a part-time position trader today, where I tend to hold stocks a little longer than a swing trader does, but we still issue swing trading ideas each and every day for those who like to trade shorter term. We also had Celsius Holdings, ticker symbol CELH. We put out an idea on it back on the 4th of November. The trigger price was $23.68. That stock shot up 38% in 7 days. So you can see that making money in the short term in the stock market is something that you can do, but you don't have to limit yourself to the stock market. You can certainly, as I mentioned, you can focus on the commodities market. You can focus upon the cryptocurrency market. The strategies that we employ, the rules that we talk about really apply across any kind of financial market. It really doesn't particularly matter what your market is. You could even apply these to the options trading market. Some people like to trade options. In fact, options are a fantastic way, I think, for many traders to make money, especially if you have perhaps a smaller, trading, you have a small amount of trading capital. Options can certainly be something to take a look at. So, on today's show, what I want to do is I want to share 5 simple rules for aspiring swing traders that I've learned over the years. And before I do, let me address a couple of things about swing trading, maybe just up front. So the first thing I want to mention is the fact that the aim of the successful swing trader is really to earn 1 to 10% within 1 to 10 days. Now, for those of you who've been with Follow the Money now for some time, we have long defined swing trading, the aim of anywhere between 1 and 5% between 1 and 5 days. But over the last several months and even the last few years, as we crunch the numbers and look at the actual data, we have discovered that many of our swing trading ideas are actually falling somewhere between 1 and 10% within 1 and 10 days. And so that's a really nice, healthy gain. But I also want to stress to you that gain really should be seen as really incredible when you think about current interest rates. I mean, if you were to go out and take money, it doesn't matter really how much money you took. You could take $100,000 or $1 and take it down to the bank. How much money are they going to give you for the privilege of them holding it for you for the whole year? Right? You're probably going to get 1% maybe. Maybe you could find 2% in some, in some place, but I really doubt it. It's very difficult to find a decent return on, with interest at any bank today. So, if you were to put money in the bank and you were to earn, say, 5% per year, would you consider that to be pretty good? Yeah, considering that you don't have to do anything. You just put it in the bank, right? 5% is not bad. That's a really nice return. We don't really see that today. So you can imagine if you earn 1% in 1 day versus 1% in 365 days, that's an enormous difference, isn't it? It's an incredible difference. So where many prospective swing traders kind of fall short, and I think they end up, kind of burning out, is they have unrealistic expectations. This is something that we teach our trading students here, all of our members. We really teach them to have realistic expectations. Look, 1 to 10% in 1 to 10 days is fine in any world, in any universe, right? That is a fine return. But many times people want more. They see people on social media, or they see traders driving Lamborghinis or in their private helicopter or their private jet, and they're making so much money. And so this this can really cause some longing in new traders to say, well, I want to earn more. And they start to swing for the fences. And they're always, instead of trying to hit singles, right, they're always trying to hit a home run. So they're always swinging for the fences. And while, that's, fine, I guess, in reality, that's not a good strategy for the long term, right? Learning to hit singles or doubles as a trader is how you can stay in the game for a long time. If you're constantly swinging for the fences, if you're always trying to get a 50% or 100% return as a swing trader or as a short-term trader, you're going to get very disappointed, and you're probably going to lose your shirt because you're going to be taking on extreme risk in order to earn those kinds of returns, and even if you can even. So having a realistic expectation is something that I want to stress to you when it comes to trading. So it's so important. Here at Follow the Money, we are not, you won't see me driving my net worth. You won't see a picture of me in my Lambo. You won't see a picture of me hopping on my private jet. Am I a successful trader? Yes. But I don't associate successful trader with, getting stuck in the consumption trap, right? I don't view my, I don't drive my net worth. I'm not trying to impress anybody through, my gains in the market. So what I want to stress to you is I think that's the right way to go forward, a realistic expectation, and also not having some sort of attachment to trading that you have to then be a massive consumer, right? You have to go out and buy an expensive car, or you got to buy an expensive plane, or you got to buy an expensive house to show off how good of a trader you are. All of that to me is total nonsense. I've been doing this for 25 years. I don't have time for nonsense like that. I'm not attracted to traders who drive their net worth. I'm not attracted to traders who, brag about their gains. In fact, if you brag about your gains, you're in fact very, very likely going to see some losses. Very important to keep emotional control as a trader, and that you don't allow the gains to inflate your head, and that you don't allow losses, which are inevitable, to crush your self-esteem. You have to learn to keep emotional control no matter what's happening. Over the last, few years, we've seen some really seismic moves in the market, up and down. And, maybe 20 years ago when I was first getting started as a trader, some of these moves might have really been emotionally hard for me, right? Especially when you see your account go up, this much, or you see your account go down this much. It can be kind of deflating or inflating, to your psyche. But over time, the successful trader learns that you cannot pay attention to those things and let them rule you, right? You have to learn from those things and move on. So if I have a really great day in the market, which happens often, especially in this wild market, you wouldn't know by talking to me. I'm not on cloud nine because I made money in the market. And inversely, if the market goes down and you were to talk to me that day, you wouldn't know that I lost money because it's not part of my psyche. To me, it's just business. And I know for many new traders, that's not even possible because it's very emotional. Trading is very exciting, but in reality, good trading, let me just be honest with you, it's boring. Let me just be honest. It's boring. It should be boring. In fact, if your trading is not boring, you're not doing it right? If it's always emotional, you're going to get burned. Really. I speak from experience. Trust me on this one. You really want your trading to be routine. You want it to be literally boring. You want to use a system. You want to use a plan, and you do it over and over. Rinse and repeat. Rinse and repeat over and over and over. So that's the first thing that I want to stress before we talk about these rules, is that you want to have a realistic view or expectation of what swing trading can deliver. And after trading for 25 years, being a swing trader and many other kinds of trader, I've been a position trader, a day trader. From a swing trading perspective, if you earn 1 to 10% in 1 to 10 days, boy, you are doing good. And you're hitting singles, right? You're hitting singles. That's what swing traders do. They hit singles or doubles over and over and over again. And you can build your account that way, slowly but surely. Now, the second thing that I want to bring up before we move into our 5 simple rules for swing traders is the fact that swing trading is just one of at least three different kinds of trading styles that you can approach or that you could take on. And let me just briefly talk about those so that you know fully what we mean when we say swing trading. Swing trading. So there's 3 different kinds of trading that I tend to think of. There's actually more, but let's just boil it down to the 3 most basic types of trading. And that would be day trading, which many people are familiar with, position trading, and swing trading. So let's unpack those briefly before we get into our rules. First of all, let's just talk about day trading. We'll kind of go from the shortest term to the longest term in terms of holding time. The day trader is seeking to trade a trend for a small profit in a matter of hours, right? So in other words, a day trader, and I've been a day trader. In fact, I spent the late 90s of the dot-com bubble really just kind of day trading. And that was a wild time to be learning how to day trade. I would enter a stock, typically in the morning. I always avoid the first 30 minutes. I never have liked the first 30 minutes. I like to sell in the first 30 minutes of the market open, but I don't buy in the first 30 minutes. It's kind of amateur hour. I like the last 30 minutes. I like the last 15. I like the last 5 minutes of the market session. Oftentimes, that's where the big money will float in. But the first opening 30 minutes, I avoid. Anyway, I would buy my stock usually about 9 o'clock my time, Central, where I was, which was usually about 30 minutes after the market had opened. And I would be in for, maybe 15 minutes, up to an hour, maybe 2 hours, 3 hours. I mean, all depends on how the trade was going. But what I would not do as a day trader is hold overnight. And that overnight risk is what the swing trader does have to take on, because the swing trader is not a day trader. Day trader buys the stock on Monday morning and sells it by Monday afternoon before the market closes. Therefore, he is a day trader. He trades in the day. He doesn't trade overnight. And so the overnight risk that you can get by holding a stock and holding it overnight, are numerous. Something could happen overnight. Negative news could come out. All kinds of things. And so that adds a little bit of risk to the day trader that he may not want. And so the day trader is different from the swing trader. The swing trader seeks to trade a trend for more profit than the day trader would make in a matter of days. So he's going to hold for a period of days. The day trader holds for a period of hours. The swing trader has overnight risk because he holds the stock overnight, and things can happen. It could gap down overnight. It could gap up overnight. But the day trader doesn't involve himself in that. Now, day trading, for those of you who are day traders out there, you know that it's very intense. And when I coach trading students on the topic of day trading, I always try to encourage them, look, unless you are, unless you've got a mind of steel and that you are, have a lot of emotional control, unless you have a good amount of capital, in fact, and unless you can stay focused and you don't mind sitting in front of a computer all day, then, I would encourage you to maybe consider something else. Day trading is fine. I still day trade occasionally. Whenever I have a free day and I might just want to go day trade, it's kind of enjoyable. But the only reason that I would do that is because I still track the markets every day for our own members here. I'm a part-time position trader as well, so I've got my finger on the pulse. I wouldn't want to just day trade and never having done it before. It's a dangerous activity just to go do for fun, right? It's not how you should approach day trading. But anyway, the point here being is that day trading is different from swing trading. Unlike day traders, swing traders can leave their computer, right? You're not shackled to your computer. So swing trading is actually a really, really interesting strategy and a fantastic way, I think, to generate a new income stream if you have a full-time job. Because swing traders will hold overnight. They will identify new opportunities. They can do their research in the afternoon when the market is closed after they get home from work, or in the morning before they go to work, they can research. And many of our members do that. They have a good full-time job during the day, but they're swing trading to supplement their income, and that's fantastic. Others of them swing trade to supplement their retirement account, right? They have a retirement account put in stocks for the long term, and then they use swing trading to kind of juice up the returns in that on an annual basis, with the goal kind of being to, have a larger overall return by the end of the year because they were participating in some swing trades. Okay, so that's day trading versus swing trading. Now let's talk about position trading versus swing trading, because position trading is also another style that people can adopt. So position traders, not like day traders, they seek maximum profits from a new trend. Now, a position trader will look for a new uptrend to begin, and he'll hop into that trend, and then he will hold that position. That's why he's called a position trader. He takes a position, and he holds that position oftentimes for months, sometimes weeks, but usually months. And in fact, when you catch a really good uptrend, as a position trader, you can be in that trend for quite a long time. Think about some of the things we've seen, over the last several years. We've had some really interesting long-term trends that have just kind of continued and continued. So position traders do well in that environment. And, of course, position traders, just like swing traders, they both have overnight risk. They both hold stocks overnight, so it's not too different in that. The capital requirements for a position trader versus a swing trader are about the same. In fact, you might be able to start with a little bit less money as a position trader. But overall, position trading is a bit more relaxed. It's a bit less intense. The swing trader is more closely aligned with the day trader in the fact that he's going to be in and out within a week or two, usually, sometimes maybe 3. But the point is that the difference here between these 3 different types of traders is how long they're in the market, right? There's a few other variations too, but the main thing that we're focusing on here is how long are they exposed to a stock or an ETF in the market. And the swing trader typically exposes himself to a stock or an ETF. He buys that stock, takes that position, and he holds it for, maybe up to 10 days, maybe a little longer, but usually around, a couple weeks. And then, of course, he's looking to earn a nice, handsome return. So if you think about it, if you enter a stock and you hold it for 5 days and you make 6%, well, how long would somebody else who took that money down to the bank, how long would it take them to earn 6% on that money? Well, about 6 years if they're getting 1% a year. I guess might not be exact, maybe 5 years. But the point is that it would take a long, long, long time for them to do what you just did with your money in, 5 or 6 days. So the point being here is that swing trading is a very powerful strategy that I wish more people knew about. And that's really the purpose of our course, our swing trading course, which I mentioned. If you're interested in swing trading, you want to learn how to make more short-term profits, learn the rules we use, the strategies that we have, that we teach, they're all in this course. And we have a ton of more materials for our members on our website. But if you want to learn more about the swing trading course, go to followthemoney.com/shop, and you'll see the swing trading course. We also have a position trading course there. We also have our options trading course as well. There's all kinds of stuff that you'll find. Okay, but let's just dive in deeper now, and let's move into our trading rules. The trading rules that I want to share with you today if you are a swing trader. So these are all applicable to swing traders. And they could be applicable to other traders as well. But I want to talk to those who are short-term trading as swing traders today. So the first rule, simple rule, that you can begin to use and begin to implement in your own trading as a swing trader is to know current market conditions. What are the current market conditions? Before you place a trade, the first question that I always ask, and I got a list of questions, right? I got my little trading plan, and I got to make sure that my trade is not violating my plan. And so before I place a trade, the first question that I ask is what direction is the current market trend? Now, it's important to know because the market can go up, it can go down, or it can go sideways, right? Those are the 3 different directions that the market can go up. So because historical data shows that 3 out of 4 stocks tend to follow the overall trend of the broader market, it's important that we don't play contrarian as swing trader. Instead, we want to find out what direction is the overall market going. The never-ending stream of financial news means little to me personally until I have seen the chart of the market's major index. Bernard Baruch, one of the greatest traders of yesteryear, and also a very, very well-known political statesman here in the United States, Bernard Baruch, put it this way. He said, show me the chart and I'll tell you the news. Right? Well, I think that's a really astute observation that Mr. Baruch had made, is the fact that you can really learn quite a bit about the market by turning off CNBC and just looking at the chart, the price and the volume. So anyway, before I place a trade in the U.S. stock market, I want to know the current state, the current trend of the S&P 500 index. I consider the S&P 500 index the most relevant overall broad market index in the United States for my purposes. And so I examine the S&P 500 index chart. I look at it in all relevant time frames to fully understand the state of the broader market. Many of history's top traders, by the way, understood the importance of waiting for a general market uptrend before beginning to put their capital into the stock market. So when the market signals a new uptrend, and we alert our members, by the way, anytime the S&P 500 forms a new major downtrend or a new major uptrend. So we always keep our folks apprised of that. In fact, you can find that on our website, followthemoney.com/market-tracker. You can see our market tracker that we keep our finger on the pulse of the current trend of the stock market, of the S&P 500 in particular. And when the market signals a new uptrend, then that's a time to be buying or adding to positions in leading stocks within the leading industry groups, within the leading sectors. And when the S&P 500 then, finally reaches a top and begins to curl over and then confirms a new downtrend, well, that's where, the swing trader wants to be much more defensive. He wants to lighten up on his exposure in the long, being long in the market. He wants to lock in gains, raise stop losses, and those kinds of things. But my point here is that if your goal is to make money from the financial markets, do not fight the general market trend. Instead, let the trend become your friend, right? You've heard this. Let it become your profitable friend. That's how you will do well in the stock market. And let me add one more thing here. When it comes to market conditions and current market conditions, one of the practices that I have had for a long time is to keep track of the closing price and the closing amount of volume on the major indices that I want to follow. So if I'm a U.S. investor, well, I certainly want to know where the S&P 500 index is at any given moment. In fact, you could walk up to me at any point and ask me, where is the S&P 500? What's its current trend? What is it doing? And I know that. Now, I may not be trading the S&P 500 that given day, but I know the S&P 500 where it's at because I trade U.S. stocks, and I need to know what the S&P 500 is doing if I want to be a successful stock trader in the U.S. I have to know. If I don't know that, it's going to make my life more difficult. It's going to make my trading less profitable and all of this. So I keep a little black book, done this for years, and I keep track of the closing price of the S&P 500, the amount of volume that went into the overall market that day, and then the trading volume. And then I just use that to kind of keep track of accumulation and distribution patterns so that I know what's the big money doing, what's the smart money doing. Anyway, we could go much deeper into that, and we do in many of our courses that we teach about. But that's one of the things that I want to stress is rule number one, simple rule, just know the current market conditions. If you're a tech trader, if you like to trade tech stocks, then also pay attention to the NASDAQ, right? The NASDAQ 100, which is a tech-heavy index. Where is that thing? Is it starting to trend down? Well, 3 out of 4 stocks in that tech space are probably going to be following the progress of the NASDAQ 100. Maybe instead you like to trade healthcare stocks. What's the healthcare sector ETF doing? Well, you could track the healthcare entire sector and track it and know how it's doing. And then know when is a good time to be trading healthcare stocks and maybe when a time is maybe not right to be trading healthcare stocks, right? So you have to keep track of your broader market, know your current market conditions, and you will improve your trading. It's just a fact. You will definitely do better as a trader. All right, that's rule number one, know current market conditions. Rule number 2 that I want to share with you today as a swing trader, if you want to get really good at swing trading, obviously you got to learn how to do it. But the other thing that you can really do to improve your trading tremendously is to keep a trading journal. So over the last 20 plus years of my trading career, I have learned the absolute importance of keeping a record of my own personal trading activity. Without a record or a journal of my previous trades, it'd be difficult to remember which strategies worked and which ones didn't. Every single functioning system needs some type of feedback loop in order to make meaningful improvements. For example, employees of most companies have to complete an annual performance review in which their boss sits them down and tells them what they've done well and what they can improve on. And your progress as a stock trader or a swing trader is no different. A feedback loop is crucial so that you can make adjustments and refinements and improvements to your system. One definition of insanity is doing the same thing over and over and expecting a different result each time. And if you trade stocks, swing trade stocks without any feedback, I'd say you're bordering on insanity, right? Especially if you keep seeing your trade balance decrease and then you just keep repeating and repeating. Your feedback loop should take the form of a trading journal in which you record all of your trades. You say, well, E-Trade or Scott or Fidelity or Robinhood, they keep track of all that for me. That's not the point. I'm not talking about a record for tax purposes that you have to turn in to do your taxes. I'm not talking about just a transaction history. I'm talking about a journal that literally where you write down your own thoughts. Why did I enter this swing trade? Why did I make money on this trade, right? Because you want to be able to duplicate that success, or if it's a failure, you want to be able to avoid that failure in the future. And if you don't learn from the trades, the swing trades that you place, then you're not really ever going to have that feedback loop to be able to improve. So the absolute vital nature here of the trading journal, I just can't overstress. Keep a trading journal, and you might be surprised what you uncover. After every single position closes, you can return to the journal entry, discover what you did right, discover what you did wrong. But believe me, it's a very important rule that if more traders used a trading journal, spent the extra 2 minutes it takes with that trade, along with the trade, to record their thoughts, to record their reasons, to record why they thought this was a good trade to begin with. And then if it fails, to notate why. Why did it fail? Many people don't want to do this. You know why? Because it requires them to admit they were wrong. And that's, by the way, one of the big reasons why traders fail is because they can't admit they're wrong. They'll hold losing trades. They'll get into a trade and they'll just hold it and hold it and hold it. And then, in fact, this brings us right into rule number 3 today for swing traders is you want to lose money in a hurry as a swing trader, then just be stubborn, right? Be stubborn and refuse to learn, right? That's a sure way to lose money in the market. So rule number 3 is to always use stop loss orders. What's a stop loss order, you might ask? A stop loss order is simply an order that you place with your brokerage firm, whether you're using E-Trade or Robinhood or Fidelity, whatever you might use, TD Ameritrade. It's an order that you place that says if this stock or ETF or whatever you're trading, if this asset falls down to this price, if it falls down to this price, then I want it to automatically be sold. Now, the reason why stop loss orders are so powerful is that they jive right with that old common trading catchphrase that is to cut your losses short and to let your winners run. Put simply, this popular phrase emphasizes the importance of not selling a stock too quickly when it's rising, as well as not holding a stock when its price is tanking. Now, this may sound obvious, but it's often much more easier said than done. I mean, after all, if you're a trader, a swing trader, how many times have you sold a stock only to later watch it continue rising in price, or held on to a losing stock only to watch it fall further in value, right? And if this describes you, then you can break the frustrating and vicious cycle. How? With stop loss orders. So the stop loss order instructs your broker to automatically sell your stock if it falls to a price as specified by you. So in fact, the stop loss area where I'm going to sell the stock is a primary consideration I have before I even buy a stock. So before I buy any stock, I first determine two very important things: my preferred entry price, right? And my maximum loss threshold, right? Absolutely important. What am I willing to lose on this trade? And of course, to know those things, I also need to know how much am I going to earn from the trade, right? Well, with swing trading, you can expect to earn 1 to 10% within 1 to 10 days. So if you're willing to take a 20% loss for a 5% gain, well, you made a wrong decision. That's too much risk, right? Your risk-reward ratio has to be proper. So ideally, a 3-to-1 risk-reward ratio, or reward-risk ratio, where you're going to earn $3 for every dollar you risk, that's the ideal. Sometimes you got to go down to 2-to-1. But the point is that if your stop loss, by thinking about your stop loss before you even place the trade, you'll know how much risk am I really taking on here. And when it comes to stop losses and using them, many people will lower their stop loss once they get into the stock, right? So they say the stock's at 55, they enter and they put their stop loss, say, at like 52, and then the stock starts to go down. It goes down to 54, and then it goes down to 53 after they bought it, and now it's getting close to 52, and they think, oh, well, if it gets down to 52, it's going to stop out. I better lower my stop loss so it doesn't stop out, right? Oh, you've made a big mistake. Oh, you made one of the biggest mistakes that traders can make, is lowering your stop loss. You don't change your mind. You don't change the rules of the game after you start. So if you say your stop loss is at the beginning, you keep that stop loss, right? You don't lower it. If you lower it, you're responding to emotion, you're changing the rules, you're violating your trading plan. So always use stop loss orders, and as an addendum to that, do not lower them once you set them. You can raise them. Of course you can raise them. In fact, a trailing stop loss is very powerful. A trailing stop loss order, for example, will follow behind your stock as it goes up and keep locking in a certain percentage or a certain dollar amount. So it's fine to raise a stop loss, but to lower the stop loss, that's not a good thing to do. It's not a good practice. I would strongly encourage you don't do that. Okay, we're talking about trading rules here, simple trading rules for swing traders. Let's move on to rule number 4, and that is to avoid stocks and ETFs that are trading below a declining 200-day moving average. Boy, I had to learn this one the hard way. I remember when I first started trading, I was so attracted to stocks that had been beaten down, stocks that were trading for $1 or $2, $3, and they were beaten down. They were well below their 200-day moving average. And a 200-day moving average, by the way, is just simply a line that you can plot onto a chart. It doesn't exist in reality. It's an imaginary line that we can draw on a chart that shows us the price action over the last 200 days, or 200 periods, we should say. And whenever I would start trading, I would look for stocks that were beat down. I say, well, they have to go up, right? Because stock goes down, it has to go back up. Well, that's not always true, is it? In fact, oftentimes a stock that crashes and goes down is probably going to keep going down more before it eventually, if it survives. And so I would look for stocks that were beaten down, and I would try to enter them. And I would fail oftentimes, maybe 8 times out of 10. And I soon realized through a fine mentor that I had at the time, but also from just experience and historical data of my own, that whenever I entered a stock that was above its 200-day moving average and I was going long, I would do much better than when entering a stock that was trading below a 200-day moving average. And in particularly, a 200-day moving average that was declining, right? So I understand the desire to buy low and sell high. I get that. But if you read some of the best traders' comments over the years, guys like Jesse Livermore, William J. O'Neill, Nicholas Darvis, and on, what you'll find is that they say that buy low is sell high, may be fine for the investor, but for the good trader, for the smart trader, buying high and selling higher is actually the proper strategy. So oftentimes we bring wrong-headed ideas to trading, and we take even kind of blend some of our investment rules with our trading. And trading is not investing, and investing is not trading. You want to buy something that's going up when you're trading. You don't want to look for things that are beat down to a bloody pulp and that are trading way down on the ground and that don't have solid fundamentals and don't have a reason to come back. In other words, so you just want to avoid those kinds of situations. Occasionally I'll look at a stock that's trading below a 200-day moving average. If the moving average is flat and not declining, sometimes you can build the case that you might have a good opportunity there. But it's very rare that I'll choose a stock to swing trade that's below its 200-day moving average. It's tempting to trade stocks that are at the all-time lows. Let's be honest. But most bottom feeders rarely get lucky. In fact, trying to successfully buy stocks locked in a brutal downtrend is a lot like trying to catch a falling knife, right? Somebody usually gets hurt. So many traders have seen their trading capital get wiped out by chasing downtrending stocks further down in price. Do yourself a favor. Avoid stocks that are trading below a declining 200-day moving average as a swing trader, and instead stick to stocks that are in clear uptrends that are trading above a rising 200-day moving average line, and look for near-term price deviations, or pullbacks we might call them, for new opportunities as a swing trade. All right? And then finally, I think the final rule that I want to focus on in today's podcast, and this has been a fun podcast. We've covered a lot. I want to cover the fifth rule, the trading rule for swing traders, is to not be afraid of options, right? If you have a small trading account, I really, in fact, want to stress that you consider options. But many people tend to shy away from them. In fact, many people are scared by the topic of options, and I understand. In fact, I traded my first stock in 1996. My very first swing trade I placed in 1997. I didn't trade my first option until 2002. And after I learned about options, I realized, wow, I wish I would have known about these earlier. I wish I hadn't waited 5 years, to learn about options, because options can be really powerful. Now, it's true that options can be structured in a way that are very, very risky. There's no doubt about it. You can structure like naked options and things like that. Boy, you can really hurt yourself. So if you don't know what you're doing, of course, you want to stay away. But what I mean is educate yourself. Educate yourself on options. Don't be afraid of options. Some people have math phobia when they hear about options and it starts getting kind of weird, like this goes up and this goes down. I don't understand the relationship here. Well, I get it, but don't let that keep you from learning about options. Don't be afraid of them, because options can allow you to have a small trading account but earn bigger returns than you could if you were just buying the stock outright, right, or the ETF outright. And many stocks and ETFs allow options to be traded. So can you swing trade options? Well, sure you can. I personally prefer to trade options longer term. I like to do leaps, which are long-term options. So I like those. But yeah, I've certainly you can swing trade options and you can position trade options. There's no doubt about it. So options can be very powerful. They're less expensive relatively to get into, but they can still provide the same kind of return that you might receive from having to put more money in the market otherwise. So don't be afraid of options, and you can learn about options. Now, there's plenty of sources online. In fact, we have an options trading course right there on our website, followthemoney.com/shop. I go in and I spend hours talking about calls and puts. I talk about some of my favorite strategies. In fact, 3 of my favorite strategies ever are included in that options trading course. If you want to learn how to trade options, that's a great place to start. There's also some good books on the topic, right? Really good books that have been written on the topic. Michael Sincere, for example, has written a really good book on the topic of options trading. We had that at our 2019 Follow the Money Summit on our book table because I thought Michael Sincere just did a great job writing on the topic of options. I think his book is called like Options Made Simple or something like that. But look up Michael Sincere. He's done some really good books on options. But that's a great idea. Our course is another idea. And so just don't be afraid of options. Just don't do it. It's unnecessary. You'll find that they are very powerful. They can really deliver some really good gains, especially if you have a smaller account. But obviously, do lots of due diligence, educate yourself, and practice before you do anything. If you're new to swing trading, if you're new to this concept and all of this sounds good, then remember the next step is not to go open an account and start trading. The next step is education. So financial education is key, and this is the time for financial education. In this wild world we live in today, with so many wild things happening economically, you need to empower yourself. That's what we do here at Follow the Money. We educate, equip, and empower people just like you, individuals all over the world, on how to protect and grow their money, right? Very powerful. And one of the ways to grow your money is to use a strategy like swing trading. If you want to learn more about swing trading, go to our website, followthemoney.com/shop, and check out the brand new swing trading course that we've put into the store. And if you're a current member listening to this podcast, that swing trading course is waiting for you right now on our website. Just simply go to followthemoney.com, go into your member dashboard, and you will find that swing trading course at right there in our latest private group coaching calls. They're right there for you in hundreds and hundreds of hours of trading education, investing education, all designed to help you take your trading and investing to the next level. Hey friends, Jerry Robinson here with Follow the Money Radio. Many of you know that I have been position trading and swing trading and even day trading the markets for nearly 25 years. And just recently, I completed a brand new swing trading course for those who are interested in learning how to create short-term profits by swing trading stocks, ETFs, or even cryptocurrencies. In this insightful and powerful 75-minute new video course, you will learn directly from me on many topics, including chart reading skills for swing traders, 4 moving averages that all swing traders should know, the best indicators for swing traders, stop-loss strategies for swing traders, and I even share many powerful swing trading entry and exit strategies with you, along with 5 swing trading pitfalls that you want to avoid. This is a power-packed video course for the new or experienced swing trader. And you can get access to this brand new swing trading video course in 2 different ways. One is simply to go to our website, followthemoney.com/shop, and buy it through our online store. It's on special right now at a drastically reduced price. The second option that you have is to become a member here at Follow the Money, become a silver, gold, or platinum member, and you'll unlock instant access to this brand new swing trading course, along with a myriad of other trading and investing educational resources. If you're tired of watching stocks and cryptocurrencies and ETFs rise in price, but not actually participating in some of those gains, I encourage you to check out this brand new swing trading course, as it provides an excellent introduction to profitable short-term trading. Invest in yourself today. Go to followthemoney.com/shop and buy our brand new swing trading course now on sale, or become a member here at Follow the Money and unlock instant access to this course along with many other educational resources. Hey friends, this is Jerry Robinson from Follow the Money Weekly. Recently, we have been receiving many emails from our listeners commenting on the great help they're getting from our precious metals expert, Tom Cloud. Gold and silver are excellent hedges against the growing threat of coming U.S. inflation. Who's your gold guy? Make it Tom Cloud. With over 30 years experience with precious metals, Tom will answer all of your questions. Don't buy your gold and silver through some call center and pay inflated prices. Call my good friend Tom Cloud and speak directly with him and get all of your questions answered. For a limited time, Tom is offering free shipping and insurance on every gold and silver purchase made by our listeners. Call 800-247-2812. And when you do, tell him that Jerry Robinson from Follow the Money Weekly sent you, and he'll throw in that free shipping and insurance on your entire order. Call your gold guy, Tom Cloud, right now for the very best deals on gold and silver coins. 800-247-2812. That is 800-247-2812. right, friends, welcome back to the program. Great to have you here. You can find us online at followthemoney.com. Lots of financial education, investing, trading education, all kinds of stuff waiting for you there. You can also find it on social media. We're on Twitter, we're on YouTube, we're on Facebook. Connect with us and tell us hi. We'd love to hear from you. Now, in our closing moments of today's podcast, we want to do another giveaway. We have done these over the last few episodes. We took a break last time, and now we're going to focus on a new giveaway. And today, what we're going to be offering is our very special options trading course. Now, we've been talking about our swing trading course on today's podcast. That's also available in our online store, but we also have something that is called our options trading course, and it's a 5-hour online video course where you will learn how to leverage the power of options to generate a steady stream of income from the markets while minimizing risk. It's 8 full-length videos totaling 5 hours that will walk you step by step on how to get started in the world of trading options. This is a normally $197 course. We have it on sale right now in our store for $47. So it's a $47 value. And to enter to win this options trading course, all you have to do is go to followthemoney.com/giveaway and enter your name and your email and tell us what topics or guests or ideas that you would like to hear on future episodes of Follow the Money Radio. And we will choose one lucky winner at random and announce them, just your first name. We won't tell everybody your whole name. Just your first name and town on the very next podcast that we do. So be sure to go to followthemoney.com/giveaway if you'd like to enter for a chance to win our options trading course here at Follow the Money. It's a $47 value to one lucky winner. And of course, anyone who wants to go check out our online store, you'll find many different courses there. Go to followthemoney.com/shop and check out our offerings, and also check out our memberships if you're interested in becoming part of our growing global online investing and trading community. And with that, friends, we now come to the end of our broadcast. And as always, I like to leave you with a final word. This time, just a simple thought that education requires a lot of books, but wisdom requires a lot of time. It's a profound thought when we think about it, that wisdom is the application of knowledge. You can learn and learn and read and read. Education covers a lot of ground, but it doesn't cultivate it. That's what we do when we begin to apply our knowledge. Are you applying your knowledge today? Are you taking what you have learned and putting it into action? That's wisdom, and that's something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
All of the information contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.